So even just from a mercantile perspective, if things are going bad in China, that's going to go bad upstream of China.
But why would it go bad in the United States? Because we are obviously a net importer. So we should be isolated from that dynamic.
You would think so, but a lot of global companies that are perceiving opportunities from a booming China, some of that would spill over into the United States. So conversely, if you have global businesses that are perceiving nothing but risks and problems and nightmares from China, that's going to spill over too. It's not going to be a huge direct impact. It's not going to be like as China falls off a cliff, it's going to drag the US with it, but it will be a drag on the United States and Western growth overall. It's, it's you can't get away from it. But in this type of global system where everything, everything is connected to everything else, even if it's not as bad as what we're seeing in China, there is still a negative, call it a discount discount on U.S. growth from what's happening in the Chinese system.
And I also want to connect the dots on how what's happening in China impacts global dollar liquidity, which will definitely impact the United States to some degree. So let's back up here. You're talking about how bad things are in China. And I know the answer to this question, but I just want to kind of lead people through the discussion. Were there Eurodollar banks outside of China and outside of the United States, outside of the purview of any central bank, that were providing dollar liquidity to the Chinese banks? And does what happened to the real estate sector, therefore the Chinese banks, impact the balance sheet or the willingness to take risk to those Eurodollar banks that lent those dollars for that growth that you were talking about before that propped up the whole world?
Yeah, there's also, not just Eurodollar banks, but also the bond market. The Eurobond market's where most of the Chinese real estate losses have been posted. In fact, the Chinese have made an effort to make sure that offshore investors have borne the brunt of these real estate losses more than anybody onshore, which is another reason why the banking sector has been able to get away from it as long as it has. Because, all of these Eurobonds that were issued by China Vanke and Evergreen and Country Garden.
You're talking about Eurobonds. You're talking about denominated in the euro.
No, Eurobonds are offshore denominated. So from China's perspective, these are bonds that are issued outside of China, usually through Hong Kong, but also there's some other ones, Singapore and other places.
Okay, so that's where the euro comes in, but denominated in what, dollar?
Dollars, euros, anything, any currency other than the local currency of the issuer. So in the Eurobond market, it's mostly in US dollar denomination, but it really depends. It depends on the circumstances. A lot of global businesses will borrow in dollars, or borrow in euros, or borrow in yen based on, whatever individual corporate functions that they're trying to perform. But, we have a lot of these Eurobonds that were issued in US dollar terms and euro terms that's where most of the losses have been. So as these Eurobond markets are taking these losses from Chinese real estate entities, you got to believe, human nature says if you've been beaten and you've lost money, substantial amount of money lending to China, you're going to be chastened. You're going to be scarred from the entire experience. So as the Chinese sector posts more losses on the Eurobond market, as well as making it more difficult for Eurodollar banks to provide funding, it's not just, okay, we're gonna avoid China from here on out. It's like, okay, if China's causing us this much problem, should we look at other places too? Especially realizing that China is a big part of the entire global system. Doesn't that just raise the risk? We're going to have the same experience with, say, Vietnam. Well, maybe not, but it's certainly going to take a second look and really investigate that possibility. So rather than just issuing bonds and taking debt at low interest rates and doing it dependably and rolling over funding dependably as you did before, the fact that China's posting all these losses and creating all these headaches, you at the very least are going to take a second look at everyone else, if not a third and a fourth look. And in many cases, you're going to say, no, thank you. Or you're going to say, I'll lend to you, but I'm going to need higher rates. I'm going to need some kind of assurance and a bigger return in order to make it worth my while to overcome these risks. So even if it's not just shutting down funding, you're raising the cost of funding, which creates a greater friction for everyone else downstream of where China is.
Let's connect some more dots. So you're that Eurodollar bank that was lending not only into China, you were also lending into, let's say, the Japanese banks like Norinchukin. So you're lending to Norinchukin, so you're going to stop lending as much, or you're going to need a higher interest rate or more collateral. So their dollar funding costs go up on the liability side of their balance sheet, which would in turn incentivize them to take more risk with the asset side of the balance sheet, which could result in them going into, let's just say, CLOs in the United States. It's backed by commercial real estate, which is just a game of musical chairs, instead of going into, let's say, treasuries. So what you've done there is that problem in China has equaled more of these systemically important banks taking more and more risk with their balance sheet because they don't have a choice, while the global dealer banks are trying to de-risk their balance sheet because of what's happening in, let's say, China. So this is the cocktail that you've got to think through.
Yeah, and it's even not only the Japanese banks doing what you just said, but they're also redistributing their portfolios in other ways where they might perceive, they need to generate more return from the U.S. And so they might perceive that CLOs are securities. They're lower risk relative to, say, lending to some financial firm in Malaysia. So where before they were perfectly willing to, lend to Malaysia in US dollars because Malaysia represented a relatively low risk opportunity. Now, in the wake of everything that's happened over the last couple of years, they're like, now I'd rather just take my risks with US dollar denominated CLOs than lending US dollars to Malaysia. So there's also a portfolio rebalancing impact that we don't necessarily see or track either, because there's no statistics for Japanese banks sending Eurodollar flows over to Malaysia or Brazil or someplace in Africa, what they now perceive of as being much more risky because of everything that we just talked about here, and therefore demanding a higher return that somebody in Malaysia or someplace else just isn't able to meet, because once you get past a certain interest rate, it's just like, okay, I can't really do that. So as the Japanese are re-looking and reevaluating the risks of what their activities, they might look, okay, US CLOs they look risky to maybe outside the system, but they're less risky in comparison to some of the other things that they used to be doing. Right. So there's a whole chain reaction based on, this one thing that happens that creates this need to reevaluate risks throughout your systemic your portfolio and everything else that you're doing. There's a chain reaction that isn't just Japanese piling into CLOs. They're also probably piling into CLOs at the same time they're not doing some other things. So it's the Eurodollar used to be described as a long chain of liabilities. And while that's probably oversimplified, it really is sort of that kind of interconnected case where something over here, it's not quite the butterfly effect. It's a little bit more direct than that, but something happens over here and it ends up, causing some firm over here to lose its financing at relatively predictable and cheap and effective and efficient financing.
And if we back up a little bit here for the viewer, I want to highlight that only works to a point. So what Jeff is talking about is the rebalancing of the Japanese bank's balance sheet, assuming they're getting funding from the global dealer bank at let's just say 5%. So then that CLO at 7% makes sense. But what happens if
5 3/4?
Yeah. But what happens is if the risk increases further in China, Malaysia, Germany, the UK, Canada, etc., then what happens is that global dealer bank that was lending at 5%, up from 3%, goes up to 7%, to a point where now the Japanese bank is like, well, I can't make it work at 7% because I'm getting 7% on these CLOs, so I'm not going to, no upside and just take the risk. So then they pull back from the CLOs. They have less liquidity, which makes those prices go up, which impacts financial assets and the banking system within the United States, which, as we know, would impact the United States economy. So also I just wanted to put all those pieces of the puzzle together for the viewer, because so I don't think the retail investor really thinks this stuff through. They just look at the banking system and the economy as though it's something exclusive to XYZ country. And you've got to step back and take a more global view.
Well, that was the one thing too that led to the stock market crash in last August, was the fact that there is a connection even with the stock market. Everything you just said, as Japanese banks were selling their CLOs, and really that spiked credit spreads, And it's pretty substantial. Even though it didn't stick around, there was a substantial liquidity issue, as you just said. Without Japanese banks providing a bid for those CLOs, as soon as a lot of participants were forced into fire selling some of those assets, spreads just blew out. I mean, which means prices went down. You had not quite fire sale prices, but stress levels of pricing. And as credit spreads blow out, that led to a spillover in stock markets, because stock markets leverage positions in stock markets. There's also a relationship there with perceived volatility. So you have a volatility in corporate credit that actually becomes volatility in equities, which leads to essentially margin calls all throughout the global stock market too. So you even have that connection between something like this and U.S. stocks, because let's remember the Dow Jones Industrial Average that one Friday, or was it the Monday morning, was down 1,000 points too. It wasn't just Japan stock market and the Nikkei. You had stock markets all over the world that were liquidating because of something that really didn't have anything to do with equities. That's how globally interconnected everything is.
And I want to point out, Jeff, this whole last 15 minutes talking about global dollar liquidity, we have not once mentioned the Fed's balance sheet or bank reserves, have we?
No.
And the reason I want to highlight that for the viewer is because what you're told in the mainstream media is that global dollar liquidity revolves around the Fed's balance sheet. But if you actually think through what we're talking about with Malaysia, what's happening in China, Norinchukin Bank, the global dealer banks that are outside of any central bank purview, you start to see, wait a minute here, the Fed's balance sheet really isn't going to provide liquidity to that global dealer bank. The banks are providing their own liquidity to one another. And the only thing that really impacts the willingness to provide that liquidity is risk. It's all about risk. If the risk, you're going to have infinite liquidity, regardless of what, and if risk is high, you're going to have very low liquidity, regardless of what the Federal Reserve is doing.
Yeah, the argument they really make is that, say you're JP Morgan or some big dealer bank, that perhaps you are less averse to risk if you have access to more bank reserves that are outstanding. And it's a kind of a tenuous argument, but that's really the only one that they can make. That where bank reserves maybe some way, some fashion, some way that we can't actually determine or put our finger on it, some way the level of bank reserves affects the behavior of dealer banks. And of course, you don't find any evidence for that because it's kind of an absurd proposition. But that's really the only way that you could connect the Fed to what banks are doing, whether inside or outside the United States, but really outside the US.
Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow Rebel capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount, because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets, and I will see you in Orlando, May 23rd through the 25th.